All right, Tony, you got a pulled pork for us this week?
I have. Yes, this is a request. Interesting request, by the way. Company I wasn't that familiar with, so I had to do a bit of research on this one. The company is called MoneyMe,
This
MME.
request, by the way, comes from Matt Walker, who has built the
Okay.
regression testing system. So, and the
Yeah,
other questions that we got are from his dad, Toby. So it's the Matt and Toby Walker show today.
right. Good. Well, I think if they get that regression model running, I think we arm a few answers to questions.
Yeah.
Yeah,
All right,
so
MME.
MME, fintech company, delivering loans digitally to customers using a quick credit scoring system in an app. And their products include personal loans, car loans, although they do the car loans through brokers. Um, and they have a credit card called the Freestyle credit card. And they use a free credit score checker, which is backed by Equifax, the credit score company that banks use as well. And I guess the whole uh, process or the whole benefit of this company is that you can get access to money fast. So it's not like going into a bank branch and waiting days while you fill out application forms and having it assessed and all that kind of stuff. It's 24/7, and you can get a quick answer because the credit scoring is done there and then. Um, yeah, so they emphasize fast service and quick access to funds. Founded in 2013, they listed on the ASX in December 2019 at $1.25. Early 2022, MoneyMe acquired a competitor called Society One for 132 million. Society One was originally a peer-to-peer lender, matching private lenders who were looking for yield with borrowers who were searching for loans. And that wasn't a bad idea. However, they did have some issues with the regulators and had to pivot and change their business model to be more like MoneyMe's business model of lending funds raised institutionally to consumers. The deal included some MME shares as part of the purchase, which came out of escrow in early 2023. So there was some selling back then. Mid last year, MME undertook a capital raising at, wait for it, 8 cents a share to predominantly pay down debt. So listed at $1.25, raised capital last year at 8 cents a share. The founder, a guy called Clayton Howes, was diluted from 18.3% down to 6.9%. And they raised, the raising raised $37 million. And I guess around that time, when they brought in some new shareholders and also following interest rate rises, the company decided to pivot to profitability from growth. So the December, I've got December 23, December 23 half yearly result shows a profit of $6 million for the half, with a reduction in revenue to 105 million, down from 121 million, and an increase in credit worthiness or credit performance, with loan losses reduced from 6% to 4.6%, half on half. And the loan book balance is $1.2 billion. So they're basically saying they're not going to keep trying to grow the company as aggressively as they were, and then they're going to try and make some money out of what they've already got, which isn't a bad idea, I think. A couple of things that have happened in the last few months which piqued my interest. In November, December, the auditors were replaced, and in December, the CFO resigned with no apparent successor. So both are potential red flags on the surface. Uh, couldn't see a qualified audit in the last annual report, so it may just be that the auditor turned over as business as usual. But it has been raised with us in the past that if we see a qualified audit and then the auditors are replaced, that could be and then the QA goes away, that could be a sign that there's an issue somewhere in the figures still, but the new auditor isn't as upset by that as the old one was. The CFO resignation announcement said the search for a replacement will begin immediately. The CFO had been there for 4 years and is moving on to other things. And it could just be a small company issue that they haven't had a successor in the wings for the CFO. But it does seem strange that both the auditors and the CFO are being replaced late December in the company. So potential red flags I would raise. It's hard to know with a small company like this because sometimes things just happen. But the two things which are not a good look usually. Getting into the numbers, June 23 numbers are still what's in Stock Doctor, and so I expect there to be new numbers fairly soon in the Stock Doctor, and they don't always reflect the numbers that I just read out then, which I pulled off Google on paper, but I don't think they're in Stock Doctor yet. So just be aware of that when you're doing your own analysis on this stock, and I guess be aware in generally at this time of the year that we're seeing company reports come out and reading about them in the paper, but they don't always get into Stock Doctor straight away. They can take a couple of days or a week. So just be aware of the numbers you're using if you're running analysis at this stage. ADT is small for this company. It's $33,000, so it won't suit people who have a large portfolio. And I'm doing the analysis on a stock price of $0.087, so 8.7 cents. And yesterday or last night it closed at 8.1 cents, so it was going down as I was doing the analysis. Even so, that stock price is way under the consensus target, which I thought was interesting. And maybe the analysts know something that we don't, but anyway. Going through the numbers further, there's no yield for this stock, so I can't score it for that. Stock Doctor Financial Health and Trend is strong and recovering, so we like those companies with recovering, so it gets an extra point for that. PE is 2.28, so very low PE, so it's the lowest, and I guess the only, because up until this last half it hasn't been profitable, but I will score it for that. It's a very low PE. And PropCap is only 0.33 times, so again, very, very low. But this is a digital bank, so OpCash can be different to our normal industrial, coffee shop type companies. However, there was cash was increased by $11 million in the last year, so I think the OpCash is positive for this company, and it's even though it may be different because we're really looking at the difference between revenues from customers being operating cash flow and then what they're paying out to the people that they're bondholders or the people who they borrow money from to lend to consumers. That difference in the margin is really their operating cash flow. It's a bit of a different calculation, but it's still reasonably strong. IV1 for this company is 20 cents, IV2 is 19 cents, and the price is 8.1 cents, so it's well below IV1 and IV2. And we don't see this very often, but 2 times share price is less than IV2, which gives us another point. Net equity per share is 21 cents per share. However, net tangible assets is 9 cents per share, so a fair bit of goodwill there. But even at 9 cents, we're still able to buy this for less than book value. And interestingly enough, it's probably what the market is focusing more on, given the share price is 8.1 cents and NTA is 9 cents a share. So we give it a score for that. Interestingly, earnings per share growth is minus 48%, so we give it a -1. And I think that's probably what is going to be driving the share price in the short term anyway. The fact that they expect profit to be lower going forward. Directors hold 19%, and the owner is still on the board and still owns a share, so we give it a tick for owner founder. 3 PTL sentiment is negative, but it's a bit hard to see because the red layer shows it as being very below its sell line, but it's one of these stocks that went from $1.25 down to 8 cents. So even looking at a 3-year graph, it's still hard to see because the last year or so is pretty flat. Even looking at the 1-year graph monthly, I think it's still below its sell line because it's been going up and down, but you can draw a sell line on the 1-year graph and it's still below its sell line. So sentiment's definitely against this, and I wouldn't consider buying it until it changes. The last thing to look at is consistently increasing equity, which it has. So all in all, this score, the company's score for this is very good, which is why I think Matt Walker raised this is an issue or as one to look at. Quality is 14 out of 16, which is 88%. And QAV's score is 2.62, which is very, very high. But sentiment is negative. So I wouldn't buy this stock until sentiment returns. You don't need to wait, I don't think, for the 5-year sentiment to return. In other words, we don't need to wait for the share price to go from 8 cents up to approaching $1.25 again. But at least on the 1-year graph, it needs to be a buy using our 3-point trend line analysis, and potentially on a longer time period than that would be good. A couple of other things to note about this. If I can talk about, I'll call them strengths and weaknesses, but it's not really that kind of analysis. Competitor plenty. If people are interested in these kinds of stocks, might be a better buy. QAV score is 0.14, but it's not on the buy list at the moment for negative sentiment reasons. But if I look at the Brettolator, it's very close to positive sentiment, and it's below its sell line, but the current month is an upturn month, and the Brettolator won't take that as L2, even though it's a trough. It's the second trough to redraw a new line. So, by the end of the month, this could well be a buy plenty with a QAV score of 0.14. And Harmoney, HMY, has a QAV score of 0.2, but is still, again, below its buy line, but it is increasing in price. So they might be two companies to look at, unless, but also MoneyMe could be if it turns around its sentiment as well. The other interesting thing to highlight is that Thorn Group participated in the raising, or in fact, somebody I think who has a stake in Thorn Group did. And Thorn Group is appearing on the share register now as having a top 10 stake. Thorn Group was on our buy list a couple of years ago, TGA, but it was delisted. And Thorn Group was active in this kind of area too, in terms of providing loans to customers, and it came out of the old radio rentals business that leased televisions and washing machines and things to people. So don't know if that means anything. If it could mean that the person who invested in Thorn Group also thinks MoneyMe is worth investing in, or it could lead to some other kind of corporate activity. I don't know. But it's someone who knows the space who's now a cornerstone investor in the company. So that's MoneyMe.
Thanks, Tony. Did you work out why the share price has collapsed from $2.20 all the way down to 8 cents?
Oh, I think it's got to be debt and capital raisings would be my guess.
Dilution with the capital raisings?
Yeah, dilution was in there as well. Yeah, and we've seen this before any number of times, is that if the current capital raising isn't enough, then they're going to raise money at 8 cents a share or diluted, and less than 8 cents a share, which dilutes things even further. So sometimes a small cap company can get caught in this dilution spiral and never recover because there's millions and millions and millions of shares on issue at pennies in the dollar. Not saying that will happen with MoneyMe, because the QAV score is very good for it. But I think the question I ask myself is, what's driving the share price down if the QAV score is so good? And I think two things. I think maybe the operating cash flows is boosting the QAV score because it's not a typical industrial company. Although operating cash flow does look good and it is adding cash to the bottom line. But I think it's this earnings forecast of negative, what was it, 48%, which I think could be driving the share price down.
I had a look at their prospectus from when they launched back in, what did you say it was, like 2019? IPO'd.
Yeah.
And the chairman, Mr. Peter Code, was really pushing their growth rates at the time.
Right. Yeah.
MoneyMe has a founder-led management team that has delivered a strong track record of revenue growth, increasing at a compound annual growth rate of 42% from FY17 to FY19. The board and executive team believe the company's growth profile is attractive and will be underpinned by further penetrating the consumer lending sector, continuing to innovate our product offering and capitalizing on new revenue opportunities. It's interesting then that you said they're not focusing on growth, they're focusing on profitability now.
Yeah, and that's really a key for any company that focuses on growth, is what happens when the growth stops. And the company's now profitable, so I can't fault it for that. And it's got $1.2 billion in the loan book. So it's actually reasonably good. It's had a reasonably successful career. But now that growth's out of the business, that's giving it a different profile. And, I'm thinking about companies like Xero, which have had a big stock price reduction as they kind of grapple with how do we come off growth and return and go to profitability. And that's always the case. And that's always the case. Growth stocks have to go ex-growth at some stage. They can't, otherwise they take over the world. It's just not going to happen. Unless it's a Magnificent Seven in the US, which is now attracting so much money, it's crazy. But that's always the problem with growth stocks. And look, if it's a successful, profitable company, I think it will have its day again in the sun because it seems to be doing well on a lot of metrics. The other thing I would say is around the time it listed or the time it was founded, there were half a dozen of these kinds of companies founded at the same time or brought to market at the same time, including ones that have been gobbled up by, I think NAB bought one of these neobanks, and I think one went broke, and I think, what was the other one I was thinking of? Latitude, the old GE Money, I think bought one as well. And Latitude operates in this space as well. It provides the loans to buy your fridge at Harvey Norman and pay no interest for 5 years, that kind of stuff. So it's a contested marketplace. And potentially we saw Society One acquired by this company, and potentially there'll be more consolidation in the field as well. So that's something that people have to be aware of.
Good stuff. Thank you, Tony.